to Financially Fluent with Ray Godleski of Southeast Wealth Partners. Our goal is to equip you with the knowledge and tools necessary to navigate your financial journey with greater ease and efficiency.
Hey, good afternoon, and welcome to the next episode of Financially Fluent. Today, I'm really excited to have Mike Yeager from Pacer ETFs. Welcome to the show.
Hey, Ray, good to see you again.
Yeah. Well, it's a Monday afternoon here. I always like to date it. Today's August the 11th, a date of the recording. How was your weekend?
You know, it was pretty good. I'm in that phase of life right now where I have young children, so they're bringing a lot of things home from schools. If I sound that way, a little congested, that's why.
I do remember those days. Well, good. Well, I'm so glad you made it here today. Maybe just give us a little brief intro, who you are and your position with Pacer.
Sure. So, Mike Yeager, I'm a divisional manager with Pacer ETFs. I've been with Pacer. This is my 8th year now. Prior to that, I was with Goldman Sachs and Susquehanna International Group in various roles across Wall Street and external and internal wholesaling. Really excited to be here. I've spent a couple of years as a wholesaler covering Florida, and then now as a divisional manager in the Southeast with Pacer, and seen a lot of growth. So over the years, I've had the opportunity to work with financial advisors like you, and I'm excited to be on the podcast now.
Yeah, that's awesome. So glad you're here. One of the things we like to start off with is, I don't like to take anything for granted, is ETF, so which is not EFT. So if we want to just define that for our audience, what is an ETF?
ETFs are exchange traded funds. And so they're pooled vehicles where think of it like a basket of stocks where you're able to buy and sell them on an exchange. You can think of them similar to, say, a mutual fund, except for the fact that they are able to be bought and sold throughout the day versus, say, a mutual fund that you're purchasing at one time at the end of the day.
Right. Yeah, we're definitely going to get into some of those differences. One of the things I want to ask is, when you think about money lessons that are learned the hard way, because that's what's interesting is, we're not just, in the financial services industry, we're also individuals, right, from a personal planning standpoint. But any kind of aha moments you wouldn't mind sharing that maybe you found in your lifetime, could have been an early mistake or just anything that's kind of shaped your own personal investing philosophy?
Yeah, sure. So when I think about this one, I think about investing versus trading. And so when I first started out in my career in finance, you would always hear a lot of really good ideas and people coming out with an idea. And the one that sticks out to me many years ago was someone referencing a good opportunity with, say, natural gas futures. And so I found myself investing, or rather trading, with an ETF or an exchange traded product that was focused on natural gas. And what I found really quickly was I was finding myself getting whipped around one way or the other. And I learned really quickly that there is a big difference between investing for the long term and then trading based upon short-term ideas, if you will. And so I would say my aha moment there with investing based on versus trading was something where you're identifying a long-term goal and identifying how do you get there, and that there is an input to that. So what is the rate of return that I need? What are the amount of contributions that I need to make? But they're all focused on like what this end goal is in mind. And that's truly investing versus, say, just trying to get in and out of positions really quickly or trading.
I think that's really good. And that's why I like having these episodes, because while that is true for folks that they're still working, they're younger, it's also true for those that are, older as well, because a lot of times, you're retiring, you're not, needing all your money in the first year, right? You might have monies that you're not touching for 10 years. So it's really important, to understand that, some of the money that you had needs to kind of last for the long term to offset inflation. So appreciate you saying that. And again, this is why I like recording these, so that they can be shared with others, no matter, when their time horizon, whether they're retiring tomorrow or in 30 years. So well, very good. Let's transition to, I'd like to call it ETFs, mutual funds, and individual stocks. So we're going to talk about the differences there, pros and cons. They all have them. And I'll say this to the audience, which is, anytime we do a recording, whether it's about taxes, estate planning, investments, whatnot, insurance, we're not making recommendations for any specific product or strategy. It's always best practice to meet with someone, whether it's virtually or in person, uh, individually. What are you trying to do? What is that individual trying to accomplish? And so that they can understand, get kind of specific advice. But we're going to talk broadly right now. And so let's start off with an area you're very familiar with. I know you're familiar with all of them, but from an ETF standpoint, before we even get into the pros and cons, why do you, and this will probably cover it, but why do you think they've exploded in popularity?
Yeah, that's a good question. So there's about $15 trillion in ETF assets under management. And really, when you look across the board in the industry, about three quarters or a little bit more than that of new fund launches are ETFs. And so they're garnering a lot of attention and garnering a lot of share. And I think that it surrounds probably three main reasons. The first thing that a lot of people are familiar with is cost. And so in general, they tend to be on the lower expense side than, say, their mutual fund peers. The second thing would be tradability. So having the ability to buy and share a share of an ETF throughout the day versus, say, just having one fixed price at the end of the day for a mutual fund. And then the last, and I think the biggest of the three, is tax efficiency. And so you're able to do something in an ETF that is very tax efficient and in comparison to, say, a mutual fund that is a lot less tax efficient, even if you're doing the same strategy in both.
Yeah, that's so true. Do you think there's any kind of misconceptions that you're often hearing about ETFs specifically?
Definitely. The first is that they're index tracking or passive. Some of our peers in the industry, Vanguard, State Street, iShares, they built these behemoth industry, overall asset management companies. And a lot of it is to keep the costs low and track an index for the long term. But and they've done really well doing that. But really, that is just one part of the ETF industry. And so there's passive, there's active, there's allocation funds. Just to give it some statistic for you, in the past year or so, about 80% of new ETF launches are active. So it is a big misconception that ETFs are just passive strategies.
Okay, so walk us through an active ETF strategy. When would they make changes and why?
Well, I think it's important to note that there are some active ETFs where they operate exactly the same way as their mutual fund counterpart, where you have some of these big ETF managers or mutual fund managers that are converting their mutual funds into ETFs. And a lot of that is because they can do the same thing by and large that they do in a mutual fund. They can just do it more tax efficient inside of an ETF. And so there's a lot of similarities that they can convert from the mutual fund into the ETF and take advantage of that cost, tradability, and tax efficiency that I mentioned without really changing the strategy, so to speak. Now, there are other types of ETFs that are maybe a little bit more rules-based, where they're trying to take an index and make it a little bit smarter or better. That's different than just tracking the S&P 500, for instance, that may do so on a set basis or a set schedule. And so there's a little bit of difference, but depending on the type of ETF that you're purchasing.
Yeah, because sometimes I'll hear people say, well, the ETFs, they're nice and diversified and they're not risky. And I'm like, well, not all ETFs are made the same. Are you using it as a leverage, as a subsector? You know what I mean? So it's just cool that you can do all these different things. And not to mention, there's ETFs that are out there that they could have a high concentration, right? I mean, you've seen those where they have a very high concentration versus a mutual fund. You agree?
I think, you're starting to see some launches out there where they're individual stocks, like, say, Tesla, and then they'll toss leverage on top of them so you can get
Right.
3 times the exposure to Tesla. And so I think, to your point, there are certainly ways that you can make a strategy and take it and exponentially drive the risk through the roof.
So there could be some bias here, but you never know. Let's talk about mutual funds for a second. Where might those fit in today's landscape?
Well, I think that, like we're talking about here, there's a big movement towards ETFs. And
Hmm.
so there is that, asset management wise, you're seeing conversions into ETF, you're seeing new launches into ETF. And a lot of that is because you can do that very tax efficiently, cost effective, and you can, in other ways throughout the day, have more than one price at the end of the day. But we do come across them a lot in 401ks. We do come
Hmm.
across them, let's say, in qualified accounts, so your
Hmm.
non-taxable dollars where you're kind of not succumbing to the capital gains that are kicked out on an annual basis from a mutual fund. So it level sets the playing field to a
Hmm.
otherwise more tax efficient strategy. So you're able to um, really just buy a strategy versus another one based upon the merit of its long-term ability to drive alpha and outperformance or whatever the strategy is that it's aiming to do.
I was curious about that because I think you're right. We see mutual funds inside of 401ks all day long. Are you seeing any movement there in 401k plans with the ETFs, or is it pretty much still mutual funds across the board?
You're seeing a little bit of it, in fact, but not a lot.
Hmm.
You are starting to see now that a lot of these big asset managers that I mentioned, DFA or JP Morgan, some of these big asset managers are converting some of their mutual funds into ETFs. They are really starting to lobby for ETF share classes, and so you're
Mm.
starting to see some movement there. I haven't seen a huge uptick in that conversation yet, but it is starting to be had.
Yeah, that's the thing. I think uh, if people are investing, they know there's differences in mutual funds between a share or a C share or institutional
Mhm.
share. But at the moment, I guess we're not really seeing that with ETF.
Yeah, these people ask me all the time, "Hey, what's the share class?" And it's just one ticker symbol. And so, if you wanted to buy one of our ETFs, it's just one ticker symbol. And so that's something that to kind of stay tuned into in the ETF world is that share class designation.
I guess the other thing for just the audience to realize this, because every once in a while I'll see people and they'll say they see ETFs, therefore they think equities.
Mhm.
And the fact of the matter is, it could be bond ETF, right?
Yeah, that's actually a big area of growth. I mean, you've seen a lot of launches within the fixed income space around ETFs that aren't just index tracking. And so that going back to
Hmm.
our original conversation of a misconception, not all bond ETFs now are, say, passive or index tracking. So you have the ability to buy some strategies that are truly active. We do one here at Pacer. So it is certainly something that you can utilize inside of your portfolio. And again, you get a lot of the benefits that I've mentioned previously.
Okay. And so now we've talked about ETFs, we've talked about mutual funds. I want to talk about individual stocks. When do you think maybe stock picking is appropriate?
I'm I'm kind of reminded of a quote from Peter Lynch on that one, where he says, "Know what you own and why you own it." And so if you remember remember that you're buying shares of a company. You're not just buying tickers on a screen. And so if you're a user of these of their goods and services or their widgets, whatever it might be, and that helps you buy shares of that company and hold on to it for the long term, I do think that there is some value in that, but it is worth at least mentioning that when it comes to individual stock picking, um, if you look over the past decade, almost 90% of active managers have underperformed their benchmark. And they do that as a career. And
Hmm.
so if they're taking all of their time and spending all of the money to do the research and they're still underperforming, say, a passive index ETF or index itself, it really can be humbling, if you will, and make sure that from a long-term perspective, I want to make sure that I am reminded of that fact that there are people out there that do this all day long as a career and they still have a hard time outperforming their benchmark.
If you're looking for advice specific to your situation, then take a look at this episode's sponsor, Southeast Wealth Partners. To learn more about their team and approach, go to southeastwealthpartners.com. Southeast Wealth Partners is a great next step to be financially fluent.
Yeah, no, that's very solid. I agree. And certainly you see very large accounts that they might have some individual stocks, but I think I see from a trend standpoint, what I'm seeing is maybe those large cap value, maybe those large cap growth are in the individual names if there's a lot of money in there, but the small caps, almost seems like, that people are going mutual funds or ETFs on that. Again, probably mutual funds only if it's in a retirement account. ETFs on both could be a taxable account or a retirement account is kind of what I'm seeing. And as a matter of fact, on that thread, we're gonna have a private investor podcast coming up here in the next couple months, and what we're seeing is that even some of the small caps are being replaced by private investments. Have you seen that trend at all in the ETF space?
Certainly, it's been coming up a little bit more and more, especially as you start to see a bigger piece of an overall portfolio starting to go towards these alternative asset classes. I mean, just look over the past week or so where Trump announced that we can start to invest some of our 401k dollars into alternative investments. And so
Right.
really it's opening up more and more for that private equity, that private credit, especially as it garners a bigger piece of the overall portfolio. And so that begs the question, you have some of these, OpenAI, I think in their last round of funding was north of a $300 billion market capitalization. And that's all been done privately.
Right. Yeah. Yeah. I think it's a trend that I'm seeing, and I don't know if that's going to change. But well, let's shift gears a little bit. For somebody that's like I say, we have listeners in their 40s and 50s, and we have listeners that pass that on to people in that age bracket. But if they were looking to build some wealth, what are just some basic tenets you would think they need to do because that's a common question. Well, how much should I be saving in my retirement account? How much should I be saving in general? Again, this is broad advice, but you got any kind of thoughts around that?
I think it goes back to, begin with the end in mind. And so, like, where am I trying to go? And that's going to tell me, based upon the dollars that I have today, what the rate of return that I'll need for that end goal, so to speak. And so, whether it's retirement, education, so on and so forth. But I'm reminded of a Charlie Munger quote where he said, the first rule of compounding is never interrupt it unnecessarily. And so I do all these meetings all throughout the Southeast, and I meet with financial advisors like yourself. And we talk a lot about this topic in particular. And what I'm reminded of that people that get in their own way is emotion. That emotion leads to why a lot of people don't achieve their long-term goals. Like, what do I mean by that? We hear the term buy low and sell high, and sometimes that emotion makes us do exactly the opposite. That in April of this year, when the market's going down 20% in the middle of the tariffs, that fear of loss can take over and make me want to just cash out and move the cash. And that would have been a big mistake. And there's countless examples of that. And so, and going back to, I'm a big Peter Lynch fan, in case you didn't notice.
Yeah.
Peter Lynch did a study. For those of you who aren't familiar with who Peter Lynch is, he was one of the best fund managers pretty much ever. He was a manager of Fidelity's Magellan Fund from the 70s all the way up until 1990. And he averaged about 30% per year, so annualized, in his fund. He did a study on what the average investor in his fund actually participated in. Like, what did they get? And you know what it was, right? They were negative.
Oh, no.
They did the exact opposite. So all they had to do was just buy his fund and not sell it, and they would have gotten 30% per year. But they actually did the opposite and were negative. They would buy after the outperformance and then sell subsequently after it underperformed. And so that's what I think about combining those two quotes. Don't interrupt the compounding, and don't let emotion get in the way.
No, I think you're right. I mean, we've seen that in very recent history. You mentioned April. I had a review with a client this morning. The couple came in, and they were one of those that called in April, like, do you think we should go with cash? Retiring in like 15 years, right? So, but yeah, to your point, it's and you go back to 2022, that was not a good year in the markets, bond or equities, but here we are at all-time highs. And so, and people often think, well, it's at all-time highs, it can't go higher. But I think we got some white papers that say that's not true as well. Agree?
Yeah,
So,
that's the other side of it, right? Is hey, it feels it really, like, there's a lot of risk out there. There's
Mm-hmm.
tariffs, there's, geopolitical tension. And it's always interesting for me to look at that. There's an old saying that the market climbs a wall of worry. And you could always
Oh yeah.
point to these different points in time and what the worry was at that period of time, why I would have wanted to sell, and why I thought the market was going to go down because of it, but it just continued its advancement.
Well, I want to ask you a question about Pacer, and again, this is not a recommendation, but what would you say is the kind of the a popular ETF that Pacer has, and kind of explain the behind the scenes mechanics of why it works, if you don't mind.
Sure. So we run a series of free cash flow based ETFs at Pacer. And so we do it in large cap, small cap, international. We do it in value. We do it in growth. And really what free cash flow is the cash that's left over that a company generates after it pays all its bills, after it pays its interest, taxes, expenses. And those are the dollars that company can use to buy back stock, pay down debt, pay a dividend, raise a dividend. You can't pay a dividend in a sustainable way or raise it without free cash flow. It's also what's used on more of the growth side of the equation to reinvest in the business to self-fund your future growth. Let's think about on the growth side of things, companies that they want to continue to innovate. Otherwise, other companies will catch up. And so they need to invest in research and development, human capital management, mergers and acquisitions. And they pretty much have two options. They can generate their own cash flow through their own free cash flow margin generation, or they can go to the capital markets to take out a loan. One's a little bit more higher quality and sustainable than the other. And so the ticker symbols on our large cap value ETF would be CALZ, that's free cash flow based, and then CALG would be on the large cap growth side. But everything we do there within our cash cows would be free cash flow focused.
Okay. Yeah. Well, thank you for sharing that. Now, what would you say if there's a book or a podcast out there? I know you got some people and some quotes that maybe change. And by the way, you can't use Financially Fluent, so that's not a available option to answer this question. But what's a book or a podcast you think that it's kind of changed how you think about money?
I have to think about that one since you really handcuffed me with the Financially Fluent. So I would say the book that fit that criteria for me is a book called Psychology of Money by Morgan Housel. And so I really just think it does a great job of framing things through a psychological perspective. I mentioned the emotional side of investing. A lot of people think it's just numbers, but in reality, there's a psychological side. And so, for instance, one of the things that he takes some time and talks about is that your perspective shapes your decisions. And I think that is kind of fascinating because everyone has unique experiences and goals and upbringings and their experiences with money. And that shapes how we become investors, and to the positive and to the negative, to be quite frank about it. And so being aware of that, I think, is really fascinating.
I'll tell you one thing that questions I'll get sometimes is somebody will say, I've got $10,000 to invest. What should I do with it? And of course, there's a whole checklist of things I got to know before I can make any kind of recommendation on that question. But let's pretend for a moment somebody's got their emergency fund done. They've been getting what they need to get done from an employer match standpoint. So let's say it's long term. Somebody got $10,000. They're not going to touch it and it's going to be in a taxable account. And they just want to, it's burning a hole in their pocket and they really want to invest it. So any thoughts on what they would do, or maybe more along the lines of what process should they go through, being that we've already checked off some of those other things I just mentioned?
This is the Financially Fluent version of Wolf of Wall Street, where he says, "Sell me this pen," right? So,
right.
Investing in, I've been having this conversation a lot. The conversation that a lot of people have been bringing up a lot is artificial intelligence and AI, and how do I invest in it? And really what I've been diving a lot into is, that there is a massive spend that's going on within artificial intelligence. There's about $350 billion that's being spent by Microsoft, Google, Amazon, and they're spending those dollars because they have to in order to take place in this transformational technology. They have to build out their ecosystem, so to speak. And if you think about how AI works, like if I wanted to use my iPhone here and plug into Chat GPT something that, what are the 5 best investments for 2025, that information, the data pack, it runs to a cell phone tower, it goes into ground into fiber, and it goes to a data center. So that's why all the talk around data centers have been coming up a lot. And that's where the physical internet is, basically. Like the server that is made by the hardware like Cisco, running on NVIDIA's chips, operating on software companies, clouds or Oracle, things like that. And that's where all the data is actually processed. And it spits the information back out to me and gets to my phone in a second or less. So AI is really a big data story. And if you follow the money, the spenders, the receiving companies are along that ecosystem. And so there's an ETF, we sponsor it. It's TRFK, Traffic, that invests in those companies. And so really it's the AI ecosystem. So that's really how I'd be investing that.
So, okay. Yeah, that's good. I think I always like to look at themes or trends. And one of the things that I see that's trending, and I figured you guys in the ETF world would be able to add to it, but I definitely see buffered ETFs or full principal downside protection ETFs. Those seem to be trending. What other kind of emerging things are you seeing in the ETF world? And we mentioned AI, of course. There's that. Anything else you're seeing?
Yeah, so there's definitely that design for an ETF that is outcome oriented. So buffered ETFs, that's a big one. I really have been seeing a lot of conversations going towards how do I generate equity income? And the reason for it is because, years ago you could get a decent yield on the S&P 500. However, today the S&P 500 yield is about 1.2%. And so it's become a growth index. And so in order to generate yield on the equity side of the portfolio, people are being forced into basically giving up on growth. And so whether that's through these dividend paying ETFs or cover call writing ETFs, you're seeing a lot of growth there. We think that there's a big opportunity within an opportunity to address both. How do you generate good growth and income and repackage the S&P 500 that way?
That's good. Well, let's see here. We're kind of getting towards the end here, but when people are looking at metrics, obviously past performance is super transparent, right? What's been going on with that particular security, ETF, stock, or mutual fund. Any kind of rules of thumb on, well, how do we look forward though, right? How does an investor go, this is going to be the right one for this part of my portfolio? What should they be looking at? What are some good metrics they should be looking at?
Well, I mean, I think risk is always something that we have to evaluate. How does a strategy, what does it look like from an upside downside capture ratio perspective? Because if I'm able to capture, for instance, 100% of the upside and only 80% of the downside, there's an asymmetrical relationship between downside participation and upside gain, meaning that if I lose 10%, I don't have to gain 10% to make myself whole. I have to make 11%. Going all the way to, if I lose 50% of my portfolio, I don't have to make 50% to make myself whole. I have to make 100%. And
Right.
so downside risk management is really important. But I'll give you another one and a tangible tool that your listeners can use, especially with ETFs. And really, it's diversification. We have a big concentration risk issue inside of our portfolios right now because there are 7 companies that represent such a large portion of market cap weighted indexes. The S&P 500 has about 30% allocated to the Magnificent Seven. So you're talking about NVIDIA, Microsoft, Apple, Google, Amazon. So these are good companies, great companies, but for every $100 that I invest, 30 of that goes into those companies. So I'm very reliant on them inside of my S&P 500 exposure. But I'm finding that you're doubling down on those positions if you own the S&P 500 and then you do, let's say, a market cap weighted growth index. Growth indexes have about almost 50 to 60% allocated to those names. And so I'm not getting much diversification if I own the S&P 500 and then a growth manager. And so there's a tool, it's called ETFRC. It stands for Exchange Traded Fund Research Center.com. And you could plug two ticker symbols in right next to each other, and it will tell you what the overlap by weight is of the two strategies. And so really, when you ask what are the things that I should be considering right now, I want to make sure that if I'm buying a strategy that is growth next to something else that's growth, that I'm not just getting more of the same stuff.
I think that's really good. Thanks for sending that or telling us about that website. I think this year, especially at least in Q1, right, the first quarter, I think we all got reminded about diversification because, like you said, it seemed like just kind of got passive into getting into the mega cap, and then we saw, oh, wait a minute, there is international, there is emerging markets. People kind of had forgotten about those. I think diversification is important. I mean, certainly there's a rule of thought that says you can be over diversified, right? You wouldn't want to have 1,000 positions, I don't think, but to your point, even the psychology behind it, when you get into diversification, I think what that helps people do is, when something's not working in a portfolio, but something is working, hopefully that helps them kind of stay interested and be optimistic, right? And at the end of the day, I don't know if this is true in the future, but it does seem like over long periods of time, things tend to go to their means, right? So if large cap value or something is just way off, and then all of a sudden it eventually will kind of get better, and if large cap growth way overbought, eventually it kind of gets sold. So I like what you said there about diversification, and we are getting closer to what some listeners like, which is the trivia portion of the show. But before we get into that, is there anything just in general you want to make sure to mention to the audience before we kind of transition to that part of the show?
The one thing that I am reminded of as we go through all this is really that it's all about having a plan. That you want to make sure that you have a plan, and so that's one of the reasons that I believe so strongly in working with financial advisors like yourself in developing that plan, because it all starts with the end in mind. What is the goal? What am I trying to accomplish? And then I fill in all those pieces.
That's a real good point. It makes me get inspired to probably might do a Q&A show on just financial planning in general. But well, thanks so much for kind of sharing your insights about ETFs and things like that. And you hopefully know that you can't escape this show without doing some trivia. So what I'm going to do is we got about 3 different categories to pick from, and then once you pick one, that's only going to leave 2 for the next guest. So here's the choices for today. We can pick sports, music, or U.S. trivia. Which one would you like to answer today for us, Mike?
Let's do sports.
Okay. Well, it's going to be Olympic sports. Hopefully that's going to be all right. Here we go. Which U.S. figure skater, and if you need multiple choice, we'll give it to you, but I want to see if you can get it without the multiple choice, won the gold medal in the 1994 Winter Olympics shortly after an infamous incident involving a competitor, Nancy Kerrigan? So if you need multiple choice, let me know.
I'm going to have to either phone a friend or multiple choice. So let's go with multiple choice to start.
It's a little tricky because of what happened back then. So
Yeah.
A is Nancy Kerrigan. Probably not the answer, right? Could be. B, Tanya Harding. C, Christy Yamaguchi. Or D, Oksana Bayul.
B, Tanya Harding.
I'm so sorry.
Oh,
so
man.
she's the one that attacked Nancy Kerrigan, believe it or not. And I thought it was Yamaguchi, but evidently it was Oksana. So,
Oh, man. I should have gone with that.
that was a really tough one. You're like thinking we're going to get basketball or football or baseball or something. So, but thank you for playing that. And just to kind of recap from today's episode, again, there's no recommendation of one strategy over another. I always encourage our audience to do your due diligence. But I do like what Mike was saying today. I think there's some really good thoughts for folks to really think through with your investing in diversification, and is it a taxable account or not. So, and for our listeners, please share and subscribe. If you have questions, we'll have a question and answer show coming up here in a couple of months, and just send those emails to ray@sewealthpartners.com. Thanks for being on. Thanks for listening. And Mike, thank you for being here today.
Thanks for having me.
Thank you for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Osaic Wealth, Inc., member, FINRA SIPC. Osaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.